Welcome to S&P Capital IQ's October Loan Market Overview. I'm Steve Miller, a member of the Leverage Commentary and Data team. This month we'll talk about today's market landscape as well as the outlook for the remainder of 2011. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation at slideshare.net. It was a tough third quarter for the loan market. Eroding technical conditions and a darkening macro picture drove the S&P LSTA loan index down 3.4%, the biggest loss since the final quarter of 2008. In the primary market, clearing yields gapped out, choking off opportunistic deal flow. As a result, new issue volume plunged 57% to $51 billion. After August sell-off, market conditions came into better balance in September. Though retail investors continued to retreat from the market, outflows slowed to $2.7 billion, according to Lipper FMI, from a record $5.5 billion in August. On the other side of the ledger, supply shriveled as repayments outran new issue volume by $5.5 billion. With supply contracting more quickly than demand, secondary prices stabilized in September. The average bid of the S&P LSTA index was unchanged at 91. Drilling down, there was a clear flight to quality underway. Bolstered by strong demand from CLOs, banks, and insurance companies, BB loans were up 1.8% in September. Down the grade, single B loans were slightly positive, while CCC plunged 5.5%. In the primary market, it was even rougher sledding as arrangers worked to unload a slew of covenant-light loans originally inked in the spring when liquidity was flowing. Today's more sober credit conditions forced arrangers to offer significant discounting to move paper, and as a result, the average new issue clearing yield jumped to a two-year high of 8.2%. In the primary two, BB paper fared better than lower-rated paper. Though statistical evidence here is in short supply, Sealed Air's $790 million credit provides a telling anecdote. The loan printed in September at 5.2%, even as single B loans printed in the mid-8s. Looking ahead, participants roundly expect a slow and choppy fourth quarter unless, of course, retail investors re-embrace loans and re-liquefy the market. Until then, arrangers say they are taking few chances in bidding for new business. They are loading up their Flex toolkit with every investor-friendly device, wide yield caps, robust prepayment fees, full covenants, and deep OIDs. High underwriting standards usually equate to low activity, and participants expect the fourth quarter to be no exception. While average loan spreads hover at levels unseen since December 2009, default rates continue to wither. This disconnect can be traced to two main factors. First, loan managers are pricing in an increase in default rates over the next 2 years as prospects for the economy dim. Second, players are pricing in a potentially significant dislocation from Europe's fragile sovereign debt situation. Looking ahead to the fourth quarter, players are not expecting a volume surge. While BB paper remains in high demand, getting less grandly rated paper over the goal line is as challenging today as scoring on the Baltimore Ravens' vaulted defense. Until the technical winds shift, therefore, opportunistic activity will likely remain minimal and M&A financing at depressed levels. Most players think Europe holds the key to the market's eventual recovery or its further slump. A positive outcome from the EU's talks could set off a rally across the capital market that lifts the prospects of the loan market. If talks fall apart, however, things could well get worse before they get better. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video. As mentioned, you can also download this presentation at slideshare.net. Finally, here's our standard disclaimer.